What I've got this morning is I'm going to touch on a lot of things. I'm going to touch on the US economy. I'm going to touch on tariffs. I'm going to touch on what the effect of those tariffs are on inflation and what that means for the Fed. And then I'm going to touch on where that money that the Fed raises, where the money that is raised by tariff goes and why that's really important for stock market performance over the next year. So, no, the US economy is not going into recession. Scott Bessent has referred to, who's the Treasury Secretary, referred to the very good employment numbers for March, 228,000 new jobs. But the problem about that when I looked at those jobs is they're almost all in the services sector, which demonstrates why you need a reciprocal trade act to rebuild manufacturing in the US. Of that 228,000 jobs, 197,000 were in private service providing industries, of which 77,000 were in private education and healthcare, and 43,000 in leisure and hospitality, and very few in manufacturing. What's happened with tariffs overnight? Well, Kevin Hassett, who's the director of the National Economic Council of the United States, has said that the US is now holding talks with 130 countries who've come forward to get their individual deals with the US on tariffs. And he says overwhelmingly, the overwhelming proportion of those countries will get a 10% tariff rate. Although he did also talk about a carve-out for basically American firms which are operating in China, which are exporting smartphones, computers, and computer chips to the US. So what I wanted to look at was, given that all of those countries are going to get the 10% tariff, what's the effect of the 10% tariff on US inflation and what that might mean for the Fed? And the last, most recent inflation number in the US was 2.8%, which is pretty good for a CPI, core CPI number, because you want to get down to 2.5. So we're pretty close to that. But if you're going to put a 10% import tariff on these 130 countries, and around about 13% of domestic demand in the US is satisfied by imports, what that means is you're going to be putting up inflation, which is currently 2.8%, by 1.3%. That's to say that's 10% of the 13% imports. And that brings your total inflation in the US after tariffs to 4.1%. So what I then did was I ran my Fed funds rate model with that higher level of inflation. And currently the Fed funds rate is 435 basis points. And the next meeting is on the 5th and 6th of May. And I came up with a number in terms of my model where it said that the equilibrium rate, if you've got an inflation rate of 4.1%, is about 4.07%. So that gives the Fed the opportunity of cutting rates, not by not three rate cuts, as I said last week, but one rate cut of 25 basis points down to 4.1%. Last week, I remarked that market fair value I thought was about 53.24 for the S&P 500 and 76.67 for the ASX 200, and the market's run up to those levels since I said that. But the problem, the issue is that we've been used to for the last couple of years, the market just starting there and running up. Now, what I think is going to happen is I think the corporate bond market isn't as frothy as it was. So I think that's actually going to be the real fair value, and we'll be playing much closer to that than the much higher levels that we've been interested or we've been seeing. A really good way of looking at that as to why that's the case is another statement by Scott Bessent, and that he thought that the run-up when we were running far above fair value previously was a Mag 7 event, not a MAGA event. by which he meant that it was generated by the fact that the market thought that artificial intelligence was entirely an American monopoly, and when it was demonstrated that, hey, the Chinese could produce artificial intelligence as well, that sort of generated the peak in the market, and that's why I think it'll be running closer to fair value than over. Now, in terms of the future, what's really important, moving now to Peter Navarro, who I've been quoting since last November, who's the senior counsel for trade and manufacturing in the White House. He said what he said yesterday about where those that 10% tariff goes was really important, because he thinks that that tariff will raise about $650 billion. And he says what's really important is the effect of that cash flow on corporate taxes as they are going forward in the One Big Beautiful Bill, which should get passed sometime in the middle of the year. And that, of course, reduces US corporate taxes for next year from 21% to 15%, which means obviously that after-tax earnings are going to be significantly higher than they currently are, even with the same basic operations that you've got there in the US now. So what that means is next year we have a continuing rise in operating earnings per share in the US market, and funded by the tariffs, and that will keep the market going up. But that's next year, not this year. And what I think is the market needs to do more kind of work in current areas where we are now, and we should wait for the run-up later on, particularly into next year.